prudential business. So students, in our previous classes we were discussing about the concept of corporate social responsibilities, right? We have also been discussing about business ethics. Okay, so we have also been discussing about various reasons why a particular business has to undertake corporate social responsibilities, and we have also discussed about the responsibilities that a business has towards its stakeholders. Okay, so all those things have been discussed in our previous video classes, and it is there in this YouTube channel, Prudential Business, under the playlist Corporate Social Responsibility. Okay, so now we will be discussing another topic within corporate social responsibility, that is corporate governance. Okay, so corporate governance, that means what? It means what? How a corporate is governed. Okay, meaning of corporate governance, actually it consists of certain techniques. Okay, so those techniques can be your rules, processes or laws. These rules, processes and laws governs the activities of a particular corporate, okay, or a particular business. That is only the meaning of corporate governance. Okay. Next, you see, corporate governance essentially involves balancing the interest of the company stakeholders. Company, who can be the company stakeholders? They can be your shareholders, debtors, creditors, owners, government, etc., together with that of the company's primary objectives. Usually the company's primary objective, we can say it as profit, but together with profit, after they receive a particular profit, it will help them to survive in a particular business. And not only survival will be necessary, it is also necessary that for a particular business to grow accordingly, because a particular business environment is dynamic. So what have we learned from corporate governance? Corporate governance actually refers to a set of rules and regulations and all certain types of techniques that helps a particular business or a particular corporate organization to govern accordingly, to maintain accordingly, okay, to maintain its standing in the market. Okay, now how that standing will be accepted? That standing or a particular corporate or a particular business will be remaining in the market or will be remaining in the society only if it balances the interest of the stakeholders, like that of your debtors, creditors, owners, etc., together, which is primary objectives. The primary objective can be there, its survival, primary objective can be profit, and together after receiving the profit, it will help them to remain in the market, that is to stay in the market, and accordingly they will help themselves to grow according to the needs and wants of the society. So that is actually the meaning of corporate governance. Okay. Next, you see, the basis of corporate governance are accountability, transparency, fairness and responsibility. Now, accountability, that is what? Answerability. The meaning of accountability is to answer to the society. Usually this accountability happens in the annual general meeting. Usually on 31st of March everywhere, annual general meetings are conducted by the companies. In that cases, annual general meeting, the shareholders or the stakeholders ask us various questions, and a business is expected to answer whatever they have, whatever they did in the past financial year without considering any material or immaterial facts. Okay. Next, you say transparency. Transparency in dealing. Whatever the profits is, they should reveal, because if their profits are not revealed, they have to pay a lesser amount of tax. If they have to pay say a lesser amount of tax, they will violate the ethical norms that they has towards the government. Okay. Next, you say fairness and responsibility. That means what responsibility does a business has, not only to its government but also to its employees, but also to its stakeholders, any stakeholders, be it your debtors, creditors. Okay. So these are the basics of corporate governance. That means one is accountability, that means they have to answer whatever question does the stakeholders or shareholders ask them in the annual general meeting without concealing any material or immaterial fact. Material fact can be something tangible in nature, immaterial fact can be something intangible in nature. Okay. Next, transparency. Whatever their profits are, whatever amount they have transferred to the depreciation account, or whatever amount they have transferred to provision for bad debts, all those things has to be revealed, because those are some of the items which usually lessens their total income, which lessens their net profit. And if the net profit is reduced, then the amount of money that they have or amount of fair share of their profit that they has to pay to as dividend to the shareholders gets reduced. So we will be discussing the contents of a good corporate governance. Okay. Number one here is the integrated business management system. This integrated business management system, here all the departments of a particular organization will be integrated. Okay, when it will be integrated, they will be working as a team. Now take for example, in a big organization, okay, it follows certain divisional department or also functional departments. Regarding the various departments of an organization, it can be division or it can be functional. Based upon functions, it can be divided, or based upon division also it can be divided. Usually dividing a particular organization on the basis of its division, that is meant for a bigger firm having large number of different types of companies working under it. Okay, and whenever we say about functional department, that in that case a particular organization or a particular company is divided on the basis of its functions, like that of your marketing department, research and development department, sales department, human resource department, like that. Okay, so this under integrated business management system, all the businesses will, all the departments, they will be working as a team. Now take for example the sales department. The sales department has a direct link with the customers. So whatever the taste and preference of the customers are there, that the sales department is much aware of it. Now if the sales department is aware, then they will be communicating the same with the marketing department, or they will be communicating with the research and development department to reproduce, to restructure the goods to suit the customers. Now it is also necessary under integrated business management system for all the departments to have a good relationship with their customers, like that of the research and development department, like that of the human resource department. All those departments should be working as a team, they should be integrated, and they should be moving forward as a team. Okay, so this is an important element of the corporate governance, that is to integrate all the departments, and all the departments will be moving forward together to achieve the organizational goals. Next you see a documented policy management system. Here every work is done through particular documents. Take for example, a new policy has been introduced by the top level management. To make that new policy aware for all types of people working in the organization, a document or a statement will be sent, and all the people working in that department will have to submit an undertaking that they will comply with the new policies, and they have understood the new policies and they will be working for that new policy. In that way they have to submit an undertaking by signing it there. Okay, so in that case, in a documented policy management system, not a single employee of the organization is left unnoticed about the new systems. In respect of corporate governance, a new policy document system, this will enable not only the people working in the organization, but also all the stakeholders. All the stakeholders will be given a document relating what is the plan, what is the proposal, what are the objectives, what are the limitations, what will be the profits, what will be the budgets. In all those things will be written in a document and will be sent to all those stakeholders. All those stakeholders will submit an undertaking that they have verified the documents and they are expecting the organization to work according to that document. Okay. And next is an ISO certification. ISO certification, this is Indian Standard Organization itself. It is a regulatory body. That regulatory body oversees the workings of an organization. So every organization as a part of corporate governance must have this ISO certification. Next you see CAPS system, that is corrective and preventive action. Now a particular work can have certain, or a particular department can sometimes commit a mistake. Now if that mistake is committed repeatedly, then obviously it is going to hamper the organization, right? So in order to prevent that mistake in the future, certain preventive actions should be are needed to be adopted by an organization. This is also a particular system, and this is also the work under the corporate governance to oversee whether the CAPS system has been followed by the organization or not. And next, the routine internal audits. Internal audits, the audits of what it is related to financial matters. Whatever the financial statements are there, whenever they prepare, either weekly, either monthly, or either quarterly, it is necessary to audit this one. Okay, so this is also a part of the corporate governance, and in such a way that they do not hide any profit matters, or they do not hide any types of material or immaterial facts relating to whatever activities that is happening within the organization. And next is the risk management. Here you see this risk management is a very important crucial part of the corporate governance, because there are so many stakeholders. One of the stakeholders is the equity shareholders. So the equity shareholders, they are not liable, or the company is under no obligation to repay back the principal amount or the dividends to the equity shareholders if the company does not make a profit. So in that case, there is a high chance that the company may conceal the profits so as not to pay the equity shareholders. So in order to avoid such a possible situation, and in order to avoid the risk activities of the organization, so it is very necessary to have a risk management system. The risk management system will prevent the company from undertaking any risky activities, or they will also prevent the company in order to protect the shareholders to pay their fair share of profits, that is the dividends. Okay, so these are the various contents of a corporate governance. I hope this video is useful to you. Thank you very much.